I was flying back from Florida actually yesterday. I was scrolling through LinkedIn and I saw a post from an accountant friend of mine. And so I read through the article, and um, it was an interesting one. And like after reading it, and I'll tell you more about it, I was like, at the end of it, like, holy shit, 19 million. That's a huge number. And let me tell you the story. So there's this company out in California, Anaheim Management Company or whatever. They manage big sports arenas, including the Honda Arena, the Honda Center, where the team plays out there. And over the years, they were running short on cash, the arenas were. And so the management company would float in advance to essentially keep everything afloat, covering costs, keeping operations running, plugging all the holes, whatever was needed. And every time a gap was open, they filled it. And they didn't just do this kind of half-assed. They didn't wing it. They issued promissory notes. They had repayment schedules, interest clauses, all the paperwork that you might imagine for things to be legitimate. And then you look at the documents and you say, oh, well, this seems like a proper loan arrangement, like any kind of legitimate loan scenario. But here's where the story gets a little wild. So eventually, the management company decided that because of the hole in the bucket, so to speak, the continually failing operations, the cost growing, they came to the conclusion that they're never really going to get paid back. So they went to their accountants, talked it through, and they came to the conclusion that through the accountant's advice, they're going to write everything off as bad debt. So that's a big deduction, cleaning up the books. And the company took the deduction, and to the tune of about $19 million. But then the IRS showed up. Now they dug into everything, every note, every clause, audited all the revisions, the extensions. After reviewing the entire structure, they basically came back and said, hey, come on, guys, this was never a real loan. Everybody knows this. And that's it. They slammed the door shut. Now, the company wasn't penalized. The IRS actually believed that they were relying on competent counsel, like this was advice from their accountants. But still, can you imagine what a moment like that must have felt like? Imagine taking a $19 million deduction, one that you truly believed was legitimate. I guess we assume they truly believed it. They weren't trying to like take advantage of a loophole, but assuming that they thought it was legitimate, your advisors said it was, and then one day you open a letter, so to speak, that says, nope, you owe it back. Now feel that for a second. You know, what kind of pit in the stomach type of feeling that must have been. Like, oh my gosh, how are we going to make up on all of this lost ground? And the realization that the hole is deeper than you ever expected. Now take that feeling, that sudden sickening awareness, and apply it to something perhaps far more personal and far more permanent, potentially, an investor's life savings. And life savings torpedoed by one emotional decision. Because here's where my mind went when I finished that article on LinkedIn. I once had a client, some of you have heard me tell this story before, who called me during one of the worst bear markets that we've lived through, 2020, the pandemic, the business shutdown. And I can still hear her voice on the phone. Ben, I can't possibly go through another 2008 type of scenario. And in that call, she wanted my advice. She's asking for my guidance. I think she really wanted certainty. And I could give her certainty, just not the type that she thought she wanted or needed. And I remember telling her, I don't know how deep this is going to go or for how long, but I am certain that we will recover. And I have a feeling When we do, it's going to be epic. Ultimately, though, her fear was louder than my voice. She sold everything against my many attempts to shift her feelings elsewhere. And I remember feeling that frustration sort of hitting me like a weight, not necessarily at her, but at myself, because I kind of felt like I failed in that scenario. That this client had a pattern, and every time the market hiccuped, she'd call. And every time my advice was the same: simple, consistent, discipline. And I could tell that she was bored, so to speak, of hearing it, maybe tired of it, maybe frustrated that the answer or the advice that I was giving her wasn't more complex or sophisticated. But in that moment on the phone, I realized something, that there is a limit to how much we can do as advisors in the moment. In the moment. But I refused to accept that limit without a fight. In the months that followed, something unfortunately very predictable happened. She called back. Not once, but several times she called back with questions like, is now a good time to get back in? Do you think things are a lot safer now than they were before? Should we start buying again? Should we start trickling in? And variations of all that. And my answer was the same answer I gave time and time again. We shouldn't have got out in the first place. So if you're asking me what the best decision to make for your long-term financial health is, to get back in immediately. Now, because that market, the terrifying one that she couldn't stomach, recovered almost 76% from the bottom, 76% by the end of the year. On what was now a $5 million portfolio of hers, that was a $4 million bounce up. $4 million. Now take that pit in the stomach feeling from the arena story and now multiply that by the magnitude of somebody's future. Now imagine you're 58 years old, or you're 62 years old, or whatever, you're 74 years old, and you realize in the moment, because of a decision, oh my gosh, I don't think I can make this back. Not in any realistic time frame. And that is the cost of one emotional decision. And that brings me to the point of today's entire talk. Clients don't pay us for market timing. Clients pay us to keep them from stepping into oncoming traffic, because nothing, and I mean nothing, affects a client's long-term financial outcome as much as their own behavior. It's contrary to popular belief. It's not stock selection. It's not economic forecasts. It's not this ongoing back and forth about will we or won't we fall into a recession. It's not the hot mutual fund of the week. It's not direct indexing. It's nothing like that. We are the last line of defense. There is no one behind us. It's us or face the headlights. And when that panic hits, when the headlines are screaming, when the fear is spiking, when all their friends are selling, when their confidence evaporates, we are the ones standing in that gap between the feeling and the decision. And that's the value of our advice. That's what they actually pay for. And if we do it well, fiercely, consistently, relentlessly, it's worth millions. It's worth far more than the cost. And here's the truth that I want to be taken away from this week. Your price, your cost only becomes an issue when your value is in question. The tragedy is not when other people question it or have trouble realizing it. The real tragedy is when the person questioning the value is you. The tragedy is when you fail to advocate time and time again for the true worth of your advice. Believe in your value, advocate for it, defend it. because the people you serve are out there every day making decisions that could cost them their equivalent of the $19 million deduction lost. So it's up to you to be the voice that saves them from themselves. Everyone, be relentless. Have a fantastic week.